Everyone's focused on what's about to happen with the Fed rate and continued cuts, which is important, but nobody's ready for the bigger issue brewing in the background. Think about it. Does it seem like most people trust the government to bring down inflation and bring down their debt? Or does it seem like most people don't trust the government? Overwhelmingly, most people do not trust the government, which is why they're not purchasing bonds. On top of that, other countries are losing trust that the US government will ever pay them back, so they're not buying the bonds either. Even bigger than that, the central banks in the entire world are losing control of interest rates in general. This is very, very bad. Let me explain. Right now, we're seeing some very negative news about our job reports, unemployment, increasing credit card debt, and overall here in the US especially, the economy is not doing well and is trending downward. The Fed is traditionally the lifeboat here, and what they would do traditionally is that they would cut the rates so that eases what's happening here in the economy. When they do that, usually what happens is that it starts to spur on economical spending and the economy starts to rise again. However, right now the bond market is actually showing that that system might be breaking and that things are about to flip to a place where they haven't been. Now, every 2 weeks in my exclusive group over on Patreon, we have a live Zoom where members ask questions and I go over my thoughts on the state of the market and what to watch for. Recently, many were asking about this bond crisis and we had a robust conversation, so I thought I'd share some of that with you here on YouTube. Now, if you want to be in on the inner circle and get information as soon as it happens, because I do share things there first, click the link down in the description and come join us over at Patreon. It's only $25 per month and you're able to direct message me with a question at any time. Okay, so I know that you probably don't love bonds as an investment, and neither do I. But at the end of the day, bonds are actually the things that actually run the world, because at the end of the day, they're the things that actually set the interest rates for things like loans of all sizes, mortgages, and even the value of the dollar. Right now, all over the world, long-term bonds are rising at rates that are absolutely crazy. Normally when central banks cut rates, the bond market usually follows and those rates go down too, but it's looking more and more like central banks are actually losing control, and if that happens, we could be in for something worse than a recession. In this video, I'm going to give you the quick highlights on what's happening in the bond market all over the world, but specifically here in the United States, and why that matters so much to you as an investor. If you understand this, it's going to make you a much better investor, especially long term, which will definitely make you much more rich. I'm also going to explain a couple of ideas and things for you to invest in to prepare for this, and exactly how I'm investing with this new information. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So just as a reminder, and maybe for those of you that don't know, if one says bond yield or interest rate on the bond, they're basically saying the exact same thing. If bond prices go up, the bond yield will go down. If bond prices go down, the yield will go up. Well, our bond yield in the US has been rising like crazy since 2020, from 1% to over 4% in the fastest pace ever. So like I said earlier, when things usually go haywire in the financial system and yields are quite high, the central bank will decrease its Fed rate, and that brings down interest rates all around. Things like high yield savings account, money market, short-term bonds, things of that nature. The problem is that right now we're seeing a little bit of the opposite. Fed rates looks to be dropping lower in the near future while the bond yields look to be increasing, and this is the first signal that our monetary system is about to be flipped upside down. Here's a couple of quick points of what's going on in today's bonds. Number one, as we know, there's a weakened demand for the bonds, just in general. August's US Treasury 30-year bond auction lacked force, marking the year's weakest demand with a bid-to-cover ratio of just 2.27 and low participation from end users. Basically, nobody wants to buy our bonds right now. Number two is this expectation of a steepening yield curve. According to a recent poll of bond strategists, the short end of the curve, the 2-year notes, is set to fall as markets anticipate Fed rate cuts. But the 10-year yield is expected to climb, reaching 4.2% in 3 to 6 months. This moves the 2 to 10-year spread towards its widest level since early 2022. Number three, and this is the big one, is the warning of a bond crack. JP Morgan CEO Jamie Dimon called attention to mounting risks, highlighting the combination of rising debt, geopolitical tensions, and regulatory constraints that are straining bond liquidity. He warned of a potential bond market crack where confidence falters, yields surge, and liquidity dries up. If the bond market actually does crack, this is going to ripple through all financial markets. Here's what it could look like. So when I say bond crack, what I mean is that investors are going to stop buying bonds, especially long-term treasuries. Yields are going to surge because the government must offer higher interest rates to attract buyers. And liquidity is going to dry up as it becomes harder to buy and sell bonds without huge price swings. So these are the main consequences, and then I'm going to tell you exactly how to prepare for this or what to invest in. Number one, government financing costs are going to explode. The US Treasuries are the world's risk-free benchmark. If yields spike, Washington's borrowing costs on trillions in debt rise sharply. That's going to worsen the deficit. Number two is a stock market turmoil. Higher yields compete directly with stocks. If you can earn 6 to 7% risk-free, investors are going to rotate out of equities, specifically growth stocks. Now that one is a huge one. As of right now, a lot of huge investors, think Warren Buffett, have a bunch of money off to the side because they're getting a guaranteed 4.5% just sitting it there, and it's risk-free. If they can get something like 6 or 7% totally risk-free, why would anybody be investing in the stock market? And if nobody's investing in the stock market or they're pulling money out to put it into this risk-free option, that stock market's going to plummet big time. Number three, mortgage and loan rates are going to jump. A spike could push mortgage rates back above 8 to 9%, freezing housing activity. Businesses would absolutely slash investment at that point. Number four would be corporate and global debt stress. Corporations that rely on cheap debt would see refinancing costs soar, raising the risk of default. Emerging markets, which many borrow in dollars, could face currency crisis as dollar-denominated debt becomes unmanageable. Number five is a financial system instability, which is huge. Treasuries are the collateral backbone of global finance. A sharp drop in bond prices could freeze liquidity, trigger margin calls, and force fire sales. Similar to 2008, but centered around bonds. So hopefully you're starting to understand the gravity of the situation here. Let's move on to what one can invest in and how you can prepare. Here are 5 things to consider for your portfolio, and then after that, I'm going to explain exactly how I'm investing specifically. Number one would be gold and precious metals, basically a safe haven. A bond crack equals a fear of fiat instability, so that's going to bring a demand for hard assets. Gold, and silver to a lesser degree, often rallies when investors lose confidence in paper assets like bonds or currencies. Which, go check the gold market right now. Look how it's been doing over this last year to date. A lot of people have already started this revolution because a lot of people and institutions are definitely already on this track. Physical gold bullion or even solid ETFs like GLD or GLDM are great options. Gold miners like GDX and individual producers can offer leveraged upside, though they're more volatile than bullion itself. I also specifically add Bitcoin in here. I believe it's digital gold and has not only held its value, but also has sharply increased in value, and I think it will only increase more due to all this craziness. Number two to consider would be energy along with commodities. Energy like oil, natural gas, and broad commodities often benefit because they're real assets, not tied to financial system promises. If inflation expectations spike with bond yields, commodity prices tend to rise as investors hedge against currency debasement. ETFs like XLE for energy, DBC for commodities, or direct commodity exposure like investing directly in gold or silver or copper or something of that nature. Number three is cash and ultra short-term treasuries. The paradox is that long-term treasuries may collapse, but cash-like instruments and very short bills, 1 to 3 months, could benefit. They roll over quickly, so investors see them as safer compared to locking in 10 to 30 years at uncertain rates. Money market funds and treasury-only ETFs like SGOV, SHV, BIL could draw inflows. Number four is so important, and it's going to sound very similar to something that I talk about all the time on this channel, But this would be strong balance sheet companies or strong value style companies in ETFs. Firms with low debt, strong cash flow, and pricing power become more valuable when debt is expensive. Examples would be consumer staples like Procter & Gamble or Coca-Cola, healthcare like Johnson & Johnson, possibly United Health down the road, and utilities with regulated pricing. Dividend or value ETFs like SCHD and quality factor ETFs like QUAL might hold up better. We all know what SCHD is, as I talk about it often on this channel, and it's one of my biggest holdings. But this ETF, QUAL, is the iShares MSCI USA Quality Factor ETF, and it has exposure to high quality US stocks. And they access profitable US companies that have low leverage and demonstrate consistent earnings over time. So many different reports and so much that's going on throughout the world geopolitically and just in general should have you start to think about maybe not having as much risk in that portfolio, not having all of your portfolio in very risky growth, technology only type companies. I'm hoping that you have that balance with some SCHD or Berkshire Hathaway or something with a lower volatility rate. Number 5, though, is all about just buying the dip on solid ETFs. If things get as bad as what I'm talking about here in this scenario, if bond prices really do go nuts, then the stock market will surely crash. One thing is for certain though, very solid broad style ETFs are going to come back eventually. And not just come back, they'll go to all-time highs just like they did in the dot-com bubble and just like they did in the financial crisis and during COVID. This is just going to be another one of those crashes, so you might be able to find very solid ETFs, things that track like the S&P 500, total US stock market, Dow Jones, NASDAQ 100 even. You'll be able to get those at a solid price, and at that point, it's going to be a good idea to be buying the dip. So what am I doing to invest in order to prepare now knowing all this information? I firmly believe that our monetary system is in trouble. I think fiat has many issues. I think our dollar has a bunch of issues. I think inflation is just going to get worse down the road. The dollar is going to continue to lose value. It's not an if, it's a when. So what I tell all my clients and what I do myself is just make sure that you own appreciating assets. In a case like crazy hyperinflation, the people that are going to lose the most are those that have everything just sitting in cash. So solid appreciating assets are the ones that are tried and true and always have been. Things like real estate or solid ETFs, gold and commodities of that sort. Bitcoin also enters the conversation there, and that's why I hold Bitcoin for that specifically. I'm still very heavy into my 3-fund portfolio with very simple, basic, broad ETFs. I also own physical real estate with 2 properties. I've already been invested strong into Bitcoin, but recently have been adding to it, and just recently I started a position in gold. Both physical gold and a gold ETF, GLDM. If dollars start to be worth less, all of these things should increase substantially, and so no matter how bad inflation gets, I'll be okay because I have assets that appreciate and have appreciated historically through all the madness. Since I don't know exactly which asset class will perform the best, I diversify my portfolio to keep myself safe, and I would recommend the same to anyone listening. Come check out that Patreon so that you can stay in the know and you can get an alert. It sends an email directly to you when I post a blog, and I write something up there as soon as something big happens or as soon as I buy a stock. You're the first to know. So check that out with the link down in the description. Then watch either of these 2 videos to keep you going strong in investing. Remember to keep investing simplified.